Right, everything looking good, and we are live. Let me know in the comments once you guys got me coming through loud and clear, but everything looks good on my end, so let's go ahead and get this stream started. Welcome back to the channel, Crypto Trend Trader, with our midweek market update. It is Wednesday, 8 p.m. Eastern Standard Time on May 4th, 2022. Before we get started, I'd like to remind you this is not financial advice. I'm not your financial advisor. These markets are extremely volatile, so please do your own research and trade responsibly. All right, so let's go ahead and jump right in. What's going on, Crypto Deli? Good to see you. Honkiness, as always. Sotos, good to see you, brother. Hope everybody's doing good tonight. Let's go ahead and we'll do a quick recap of the Fed meeting, the FOMC meeting today, and the Q&A by the one and only Jerome, the economy master Powell. So they basically just did exactly what we thought. They got up there, did 50 basis point hike. So doubled the hike from the last meeting. I think that was right in line with market expectations. I think it was priced in at over like 95% chance of a 50 basis point hike. They didn't rule out a 75 basis point hike in the future, but basically said like, oh, we hadn't even thought about that yet, let alone discussed it. So, I think that gives the market some confidence. And then also they talked about the balance sheet runoff. So if you're not familiar with that, that is instead of actually selling off assets from the balance sheet, they actually just let them mature. So they're basically going to limit the speed at which they run off or mature. So they're only going to still allow so much. So say, for instance, all of a sudden a bunch of stuff was going to come up in 1 month and it was going to be, I don't even what a made up number would be. Let's say it was all of a sudden going to be $100 billion coming off in 1 month, and they only really wanted, 75 billion to come off that month. So they would rebuy 25 billion, but still let the other 75 billion run off, is basically what they were getting at. And they essentially said they're going to take the next 3 months to ramp up the selling. Oh man, I don't remember off the top of my head what they said they were going to do. I feel like it was going to max at 75, maybe 50 and 25 mortgage-backed securities and bonds. Was it 50 and 25? Or maybe it was 60 and 30. I really can't remember. I want to say it was 90 now, actually. So maybe it was 60 and 30. Don't worry about my numbers today. They're a little bit off. Should have took some notes, apparently. But regardless, they said they're going to ramp it up over the next 3 months. So it's going to start at half. So if it was 60 and 30, like I was thinking it is, I want to say it was 60 and 30, which would be 90 billion per month, which would be a little over. Man, that's not right. Anyway, regardless, they said they were going to do, I think, half it for the first 3 months and then ramp it up to full after those 3 months are up. I really should have paid closer attention to that, but essentially it was right down the line and I was kind of distracted. So my apologies not having the specifics. But that being said, we basically got what we would expect from the markets, a reaction rally along lines as basically the bad news was priced in. And then he came out and basically told the market what they were already expecting. Wasn't good, but it wasn't worse than they were expecting. So it was right in line with expectations. And of course, because the market is forward looking, if everything's in line with expectations, of course that's bullish because it's not bad. So it must be good, therefore by default. So that's what we saw today, and saw a little bit of pressure come off some of the crazy stuff that's been going on lately. So we see the dollar letting up a little bit, which is good. We've explained that quite a few times, how and why that is good. TNX letting up a little bit, giving the bond market a little bit of a rally. Equities, a little bit of a rally. And then obviously we saw some rallying in crypto as well. I was discussing with some group members last night, posted up in the group, about basically a falling wedge and some price targets for potential trade setup on Bitcoin and crypto just in general. And we got a nice little pop and are on our way at the moment to retest some of those key areas, but we'll talk more about that when we get to crypto. Matter of fact, we can go ahead and start with crypto today because it has been a while since we looked at crypto first. So let's do that. So we have our Bitcoin futures chart. So again, on the macro, nothing really has changed here. We basically are just hanging out in this bottom of the area in this range. So nothing really bullish or bearish on our daily chart. We did manage to close above the 8. We're still below the 21. And obviously the main thing on the daily we'll be looking for, the first sign of life out of this, will be the 8 and 21 crossing. So at the absolute minimum, we need to get back above 40,000. We do have the hard buy coming out of the bearish control zone. We have 2 green histograms on the histogram for the TDMACD. So we're starting to move back to the upside, build a little bit of momentum and some potential. So the next sign we'll look for is a close above 40K. And then after that, we're going to look for our retest of 43,620, potentially as high as like 47,000. And we'll discuss that actually a little bit on the spot market chart. So on our Bitstamp chart, I'm actually going to take this down a notch to our 4-hour chart and just kind of show off what we were looking at here in the group. So please ignore all the, you know what the best way to do this is. I'll just clear this chart and then we'll worry about it later. So basically the most important thing that I was looking at was essentially we have a pretty clear like resistance line here at the top. Depending how you kind of draw this and what time frame you're looking at, you can get it pretty accurate here. I had it like something like this. And again, that's just a resistance that we've been interacting with pretty steadily along the way. So I basically use most of the closes here. There's like one little pop-up right here that failed and then closes. And then here we've technically like kind of closed on top of it. I did have this in play before we went up to that level. But something along this line is essentially what I'm looking at. So we have this descending wedge. It's tightening, it's tightening, it's tightening. We finally come over here. We get what could possibly be a breakout or is a breakout already. Again, depending on how you've drawn it. But that being said, you know, we have many ways we can measure what this move would be. I like to take like the middle of the pattern, the meat of the pattern, and just kind of do a, you know, bottom to top type deal. And a confirmed breakout will give us essentially a target to the upside of the measure move, which is 44,000 right here. Obviously, we have the 200 exponential and simple slightly above our heads at like 40 and 41,000. And then when we start really paying attention to what's going on here, I thought I drew the pitchfork on this chart, but I just deleted everything. So we could just throw a new one up here. Where's it at? Oh, it's with the, where's it at? With the fibs, right? So let's see. Yeah, I should have zoomed in first. So I've been watching a couple of key areas. There is a fib. Sorry about that. So if we do the fib from, well, we'll do the pitchfork first since we have it. From the bottom right here to the top right here, and then to the next swing low right there. Something along those lines. And then if we do a fib also, there's obviously a couple key fibs that we need to watch right now, but if we just draw one from the 70K top to the bottom here at 33K, and then we do the pitchfork from the 33K to the initial bounce, which was like 46K, and then to our next swing low, which was back down at like 34.5, that gives us now a pitchfork, and a fib level to watch. Now let me turn off a couple of these. Okay, and then let's make this one a little bit more visible. All right, so basically we have some key areas now. Oh, you know what? I think I put the wrong fib in there. I think I wanted this one. Huh. Well, actually, don't remember which fib we were looking at. Oh, sorry. Yeah, okay. It's a couple different ones we're paying attention to. So we have the 236 here already, and then we have the micro fib, which was the retracement of only this wave right here, with the potential of a third wave coming still. So if we sort of just draw this one out of the way a little bit, and then we just kind of focus in here. So obviously we have a key fib level right here, which is the 236. Again, let me make this just one brighter. Okay, so we have the key fib level right here, which is the 236 pullback, which is essentially where we were banging our head, and then we bursted through. And then if we keep zooming in here, you'll see we have from the bottom right here, which is from our third point of contact on the pitchfork. So we're assuming basically this is like a wave one, you know, obviously of a correction or something like that. So we have essentially like some kind of an initial burst up right here. And then we're not looking at like a 5-wave structure necessarily right here. We're just looking for like, if this is a wave and we put in a certain percentage retrace of that wave, can we find something similar on our next point as well? So when we go from the bottom to the top, we know we came down like, you know, all the way back basically to the 786. So, you know, a pretty deep retrace. And then the next idea is looking at this one to this one. How far down have we come? And we have the 786 lining up right down here at the bottom. And that lines up with what would be the bottom of our pitchfork channel. And then that also lines up with the bottom of our yellow pattern right here. So that's the area I was watching for support. Now we ended up coming down to the support and then slightly front running it and coming up to the top of the pattern right here. So depending what happens here in the short term, if this breakout confirms and you know, find support at the 618 in green or the 236 in red, that would be a key area to hold. And then if we're able to hold that area, I'm looking for continuation and the measure move with, you know, potential long target, obviously. So that would be our initial basically entry point, with our initial target being somewhere between the 382 on the macro and our measured move. So we have something roughly like this. Now I took the entry slightly lower, but even right here, it's 11.2 and 5.5. So it's over a 2-to-1 risk reward ratio. So if you were going to buy the breakout pullback, you know, retest before continuation, so basically like looking for resistance flipping to support, so an SR flip, so to speak, we would want to reaccumulate back in this area around the 236 or the 618 in green, and then we're looking for that continuation measured move to the upside. And then that's just the initial move. What we're actually looking for is the potential for an overperformer. So not just that measure move right there, but a retest potentially of the top of the range, which again would be our next fib up, which is the 0.5. And then finally, the macro target to the upside is actually slightly higher. Now, does any of this have to happen, or could it all just fail and immediately go down and that's it? 100% could completely fail. Everything goes down. There's no bull case. But if there is a bull case, you know, these are the targets we'd be looking for. So that being said, we have the initial target with 11%, 11.2% target to the upside, and that gives us that 43,648 target. And then the next one we have would be a retrace to the 0.5, which is a retest of the previous high. So we have a high right here. You know, first we have the low, then we have a high, then we have a higher low, then we have a higher high, then we have once again a higher low. So we're technically still trending uptrend. Depending how you draw this, there's ways it looks like we've already broken down, but we were discussing how, you know, that would be basically selling into support if you were going to all of a sudden get bearish on the markets right here at key support levels that have been holding. So that's where the part of the thesis comes. And then obviously a descending wedge tends to break out bullishly to the upside. So that gives us our initial target. The second target is a 0.5 and a retest of the previous high. And that is a 21% move to the upside, which gives us about a roughly 4%, 4 to 1 risk reward ratio rather. And then finally we have the third target, same entry, same stop, but 29.9% to the upside. And that's coming up to basically the 618 and the top of the channel. So we have the top of the channel, bottom of the channel, top of the channel, you know, bottom of the channel. So we're looking for a potential move all the way back to the top of the channel. So nothing changes. We still trade inside the range. We potentially put in, you know, another higher low and then another higher high for our target to the upside. And we basically just go sideways range trading. Does it have to happen? No. Could it fail? Sure. The idea is to basically hit our first target to the upside and then move our stop loss back to our entry point so that we basically have taken some profits. And then even if it retraces fully, we'll just stop out the remainder of the position at break even. And then same thing once we come up here towards our second target, take more of the trade off the table with 21% gains, and then we'll move our stop loss to the previous take profit level. And then, you know, if something were to go wrong, if all of a sudden the trade flips, we still have 50% of the trade open. We then close that 50% of the trade at 11.2% gains. And then finally, once we, you know, hit this target up here, or if we hit that target up there, we will move our stop loss, you know, potentially back to our previous entry. And then we'll look for that extra, you know, finish of the 29%. But that's what I'm looking at right now on the short term and what I've been paying attention to. Basically like internal retrace of a small move right here, you know, which was basically this previous little thrust to the upside. But don't want to get too overly ambitious about this right here. There's definitely a possibility this just rolls back over and just falls right back apart. But there's definitely a trade setup here with 2, 4, and you know, even basically like what was that? Almost 6 to 1 risk reward ratio. So it's worth taking a shot on some of these. You know, will you play it with Bitcoin? Will you play it with altcoins? You know, it doesn't really matter. Obviously, it's up to you. Going to look for whatever the best setups are on various alts, and then obviously, you know, trade Bitcoin accordingly, etc. It depends on the person, though. I personally like to chart everything on Bitcoin and then look for an altcoin that has a at least equally, if not more, probable setup to the upside, and then take advantage of that. So a lot of times, what would be a 20% move in Bitcoin might be a 30 or 50% move in an altcoin, and the altcoin might actually have what looks like a more favorable setup. So a tighter stop loss with a, larger target into the future. Now, that all being said, that changes nothing on the macro. We basically still have, a distribution pattern taking place at the moment. So what I'm looking at here on our daily chart is obviously still just a high and then a low, and then just at some point in time a lower high, and this is going to be essentially an A or a 1 and then a B or a 2, and then we're looking for a further like 3 down or a C down, depending on how this develops. So while we are in technically a bullish pattern, we still have, this is our flagpole lead in, and then this is our actual flagpole, or depending on how you want to draw it, just a channel, or in this case we did the pitchfork for an example also. And you can use either, like in this case, I was using the 25, 50, 75 on the pitchfork. You could use Fibonacci numbers on the pitchfork if you prefer. It really doesn't matter, whatever like works for you or works on the chart. But in specific, I was just, when I drew it initially, that's how I was using it. So that's kind of been my fallback because it has been working so well. So yeah, that is basically our Bitcoin. So then on the daily, looking at this, not a lot has changed, obviously. Still basically looks the same. I mean, we're on the verge of, or have already broken out, depending on how you're looking at it, of a smaller wedge. But the macro wedge we're still kind of operating inside of. So you can look at, go back down for a second to the 4 hour, And just want to draw something else out here. So here is like a shorter term wedge right here. And what I was kind of watching inside of this obviously much larger macro pattern. So before the wedge I drew on here was from the top right here along these lines. And then in the shorter term time frame on the 4 hour, we can see there's an even smaller wedge right here. So this one we have technically already broken out of. And this, again, trading very, very technically inside of this descending wedge. And then the moment we broke out, we started to see that continuation to the upside. So that being said, if we look at, again, the grander picture, you know, this is basically our other wedge, and now we have the top of the wedge right here lining up with still the same kind of bottom of the wedge right there. So again, when it's all said and done, we've technically broken out of this wedge already, but we're really just filling out the larger macro wedge. So we'll see what happens with these. Obviously don't want to get too excited right now for continuation to the upside, but again, there's definitely some potential for a crypto, I mean, I would say relief rally, but we kind of just got the beginning of the relief rally. So like continuation on the relief rally, confirmation of, you know, breakouts holding, and then, you know, further targets to the upside. So we'll see what happens. We're still holding, you know, higher lows and higher highs technically within this move right here. But we do want to keep in mind that this is all still an internal retracement of a down move. So we do expect continuation to the downside. The 200 exponential and simple both angled to the downside. Obviously slope is flipped on all these. And again, the key levels to pay attention for are, you know, obviously reclaiming the 21. If we hold above the 21, then we want to continue consolidating. We want to see the 821 cross and then potential to the upside. Now, one thing to be warned about though is that here we had an upside cross, a downside cross, an upside cross, a downside cross, an upside cross, a downside cross. And while there was money to be made scalping those moves on the daily, you don't want to get too excited if we see another daily upside cross, because it could very easily just be a little fake out failure like this. It could be a new one that takes us up to a new high, or it could be, you know, just another failed breakout or throw over before we go back down and say a downside cross. So you have to, if you're going to use the upside cross as an indicator for direction, momentum, or use it as a trade entry, you need to use the downside cross as a trade exit. Obviously, this is not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. But the key to a working strategy is having discipline. So if you're going to buy when the strategy says buy on a cross to the upside, you need to sell when the strategy says sell on a cross to the downside. Now, as of now, we're still below the zero line. We still have all red histograms. I'm sorry, red slope line. We do have 2 green histograms. The second one is just forming right now. Again, we've been chopping sideways so long, we don't want to get too excited about the histograms. We have left the bearish control zone, and it looks like we're about to get the cross on the stochastics back to the upside. So again, that would line up with basically consolidation right here, and then that potential burst up. So, you know, we want to pay attention to these targets and know that, you know, our target to the upside could be as high as 52,000, and it would be no surprise whatsoever, and would not invalidate or break the bearish trend or anything like that. Now, if we start to break above, you know, basically that top portion of the channel, and again, this is how we initially had the channel drawn, and then we technically have broken down from that. So we have already technically broken down depending on how you draw the channel. Now, obviously, there's many ways you can draw things, and sometimes in hindsight, something looks better than it did. That's why I like to draw it multiple ways. But overall, you know, when we look at the longer time frames, crypto's still looking pretty rough. I mean, we're basically pushing back up to 8 on the weekly. Bunch of red histograms, still red slope line, stochastics rolling over to the downside, trend accelerating to the downside, bearish divergence on the weekly. When we look at the monthly, we see again bearish divergence between our peaks. We basically have just found support at the 8 once again. I'm sorry, at the 21 once again on the monthly, and it looks like a pushback up to the 8 would seem likely, because we're basically just chopping between the 8 and the 21 now. So realistically, 43,000 seems pretty likely right now, because all that is just the 8, and it's just the same range we've been trading in for the last 4 months. And we're slowly just kind of drifting up on the closes, kind of, you know, drifting up on the opens, or I'm sorry, drifting down on the opens, drifting up, no. Well, we see the close right here was a new low. And then we see the wicks down our lows here. So the wicks and the bodies are kind of doing the opposite. The wicks are trending up, the bodies are kind of trending down or sideways. But regardless, we're basically still just range bound. And again, just for reference, This is the most important scenario to me. Every time we've previously done this in the last, 4 years, we consolidate between the 8 and the 21, and then we rolled over and had the massive COVID dump. And then here we consolidate between the 8 and the 21 in 2018, and that was right before the 50% capitulation, where we found our bottom, which is great. So a 50% capitulation will be great, in my opinion, for many reasons. But may not happen for months, may not ever happen. But we see here clearly the stochastics on the monthly are strengthening to the downside. So when we take from right here and we look at how close are these stochastics together, here they're pretty tight. Here they're a little further away. Here they're much further away. So the blue is accelerating faster to the downside than the purple is able to follow. So it tells us the trend is still strengthening to the downside while we're kind of just going sideways. And we also have a bunch of red histograms. This is at this point in time 6 months straight. Before that, we had 2 green, a red, a green, and then 3 reds. But we can see in comparison, we have like 10 reds compared to 3 greens off of bearish divergence. So the monthly chart still looks very weak. As long as we're holding right here, it's okay. We're just range trading. We're range bound. And there's potential for like the scalp play to the upside or something like that working. So again, don't want to get overly bearish or overly bullish at the wrong times because that can really decimate you. So we basically hit our Ethereum target, give or take a couple of dollars. We were off. The top of the target was 2,688, and it came down to 2,725. So it was within like $35, pretty good. Less than 1% away from the bottom of the range, bottom of the target. At this point in time, it looks like it's trying to move back up to the heart line and the 200 exponential at 3,091. And then obviously the equivalent move to the Bitcoin move we're looking at is somewhere around like 35.97, which from where we're at right now is actually only a 23% move. So in the case of Ethereum, the Bitcoin move is actually bigger because the Bitcoin move was over 30%. This one's only 20%, maybe because this didn't come down as low, maybe because it already moved a little more, but regardless, it is not as appealing. Typically you find, a lot of times you'll find better trade setups on Ethereum than Bitcoin, but equivalent. You can usually get a little extra something by trading Ethereum. In this case, not the case. So next we have the daily chart compared to the moving averages. We are below them. They are sloped to the downside, and obviously this does not look good. We did get the sell by sell at the bottom of the range. I told you I didn't expect that to be reliable because we're at the bottom of the range. I'm not going to sell in like a divergence signal at the bottom of the range already. We're already low, so we can't go much lower. Now we see the buy following up afterwards. So at this point in time, we've kind of just been like chopping around, and I don't really respect the crosses nearly as much on here until we sort of develop a trend and pick a direction. As of now, though, we do have to pay attention to the most important thing. We are below the 200 exponential and simple, and they are sloped to the downside. So we don't want to get overly bullish on any of these cryptos. Next, we have Bitcoin dominance. If we switch this over to the weekly, again, we're still looking at these 3 drives of bullish divergence. We have bounced all the way back up, tried to cross back to the upside. Again, it looks like we're failing to cross back to the upside. So it's basically just going sideways, doing nothing. We do have a hard sell signal here, but we have momentum in our favor. So in my opinion, this is still completely neutral. It's at a neutral level. It's neutral on the indicator oscillators. Not a lot we can get from the Bitcoin dominance chart at the moment. As far as the crypto cap chart, so for a total market cap, it still looks almost identical to the Bitcoin chart. We are currently hanging on to that key level, which is that 1.7, let's say 1.8 trillion roughly. That's a key level to hold. We push back up to it, and now we're back on top of it. We obviously spent a little time below it here. As long as this kind of holds, this really just looks like the Bitcoin chart. So until something changes on the Bitcoin chart, this really doesn't tell us much of anything at this point in time. Only that we're going to continue to see Bitcoin dominance probably stay right around the same level. Because if the crypto cap is going to move up exactly like the Bitcoin chart, the Bitcoin dominance chart is probably going to stay the same too, because we're seeing the same moves on both charts. So next we have Matic. So we were looking at some key levels on Matic daily. So obviously we had this wedge forming. We broke out of that wedge, came up, we put in another top right here, and then it acted as a top a third time there. And then when we came back down, the key level we were watching was the previous resistance for a potential support. And that's exactly what happened. We bounced that support, and then we came back up. to what was our previous support, and now that would be expected to act as resistance. So once again, we're kind of pinned in this range. We did put in a new low. We took out the 382. Now we're coming back up to retest it. Typically, this will get rejected, and then we'll go lower. Tough to tell, honestly, what's going on, because some of the alts look a lot worse than Bitcoin's chart does. You know, obviously, this whole time, Bitcoin had basically a push down and then has been an ascending channel to the upside inside of a wedge, a micro wedge. This one is just in a giant wedge. So eventually you would expect this to break to the upside, but now it doesn't even really look like a wedge anymore because we already broke out to the downside, and now we're retesting what should be the support on the wedge. So this is a tough one right now. It doesn't give me a lot of a clear picture in one direction or the other. We are below the 200 exponential and simple. They're both sloped to the downside. So overall, it's still bearish. So Avalanche obviously had a nice push up off the bottom here. So we did put in a new close on the low right here, which is obviously a bearish situation. Oh, I remember that. All the losers. Hang on, I'm going to get rid of that for a second. Get rid of the winners over here too. So we bounced the 886. Okay, so we put in a new low now, and we bounced the 886. So, in my opinion, the most important thing about the 886 is it often acts as support or resistance, but rarely acts as a pivot point for the market. So we're bouncing the 886 now, but the probability of the 886 actually ending up being the bottom and then going higher, or if it's a top, going lower afterwards, is extremely low. Extremely low. I mean, it's literally like less than 10%. So when it's all said and done, while we're getting a bounce right here, we're retesting previous support levels, horizontals, etc. And we could easily see a pushback up to like 76, another 12 or so percent to the upside. I still want to really respect the descending resistance, with the exception, obviously, of this little push up here and the key fib levels, and kind of see what Bitcoin does. The 200 exponential has rolled over already. 200 simple is basically flat at this point in time. So there's still a little meat on the bone right here, but most of these alt setups are looking less favorable than the Bitcoin setup. So next we have Solana. So Solana managed to not put in a new low right here, which is good. Again, we see every one of these charts is looking different. They're similar, but they're different. So here on Solana, we put in a series of lower lows, and then we got a pretty aggressive bounce, and then we came back down, and we're still technically putting in a higher low, but we don't have like the 3 higher lows of Bitcoin. We don't have the clear channel the same way we do on the Bitcoin chart, but we obviously have I don't know what is going on with this right here. We obviously have a TradingView malfunction. There we go. So yeah, I'm paying attention to these key levels. Coming back up to retest the 236, the 200 exponential, the 200 simple, something along those lines. I don't know what the heck is going on here. So maybe like $100 probably going to act as a pretty tough resistance for this. If we were to take out that resistance now, can we call this a bottom and then look for a potential upside target? I mean, we would have something like this. So, you know, the potential, really the real trade setup on this would be if we saw it come all the way back up to like the top of the range, or retest the 200 simple or something to that effect. That would be like almost a 50% rally. So depending on how we wanted to do this, if we wanted to just have it, if it takes out the low, we get stopped out of the position, you know, based on a candle close or whatever, 12% stop loss. The initial target would be basically the 200 exponential, 19%, or the 382, which is 29%. So we'd basically be looking for something along this line right here. But the real trade we're looking for, and again, we don't want to get too overly excited with these longs, but at the same time, just because the market is telling us it looks kind of bearish, we don't want to just ignore favorable long setups either, as they can be very profitable. But here we see like 29 to 12, 2.5 to 1, and we see 49 to 12 for a 4 to 1 risk reward ratio. Again, with the target at the 382 and the 0.5 on the macro. And that's from our macro high all the way down to our low at $75. So, you know, potential pushback up to like 139 Could be in the cards. Could be in the cards. So next we have XMR. So we're obviously watching this one. We talked about taking the entry on this trade before the breakout. It ran up pretty substantially. The key was to move your entry, stop back to entry. So obviously you can't take a loss or just take profits on your position. I did not trade this setup right here, but we discussed a potential setup if it does come down a little bit deeper. So it obviously retraced back down inside of the pattern, trying to reclaim the 200 exponential and simple, was having a little difficulty right here. If it starts to get rejected, we're still looking for that potential entry at the 236 or even the macro 382. But again, don't want to get overly bullish on this while everything else looks bearish. This was looking bullish while everything else was looking bearish. And now this is looking less. Well, it still looks okay because it's at least above the 200 exponential. But, you know, we're seeing some divergences starting to take place with these crypto charts. I don't think it's enough to pay like big attention to or anything right now, but it's enough to notice, enough to pay attention to, that these charts are all kind of looking different. So if we see some with favorable setups in comparison to others, and we're going to take a counter trend trade or a long or a short, either way, we're going to look for the ones with the best setups. And then in the end, it's probably going to come down to whatever Bitcoin does. If Bitcoin goes sideways, maybe one of our alt trades can still succeed regardless. If Bitcoin goes up, you know, some of our alt trades could like overperform to the upside. If Bitcoin goes down, some of our alt trades could overperform to the downside, or at least we could have a tighter stop loss to know if we're wrong. So it's definitely worth charting a bunch of different stuff, practicing, paying attention to how everything looks right now. Not getting just stuck on a couple of specific assets and, distracted by some short move on a specific thing. We want to really pay attention to like the whole market and then the individual assets that make up that market. So next we have algo. So we looked at this a while back. I think we were targeting the 0.5 to the downside, which we hit perfectly. Yeah, we were, because it's been a while. So we were still above the 382. We were talking about lower high and then the 0.5 target to downside. So now we hit the 0.5 perfectly. This is still trading very technically. The 200 exponential and simple have flipped over to downside. So what does algo want to do now is the real question. So if we look at, we don't have a clear like resistance line here. I don't really respect that wick for anything. It's probably not on most charts. But if we look at just these 2 points of contact right here, and then we can see how this kind of lines up. Not as well as we'd like. There's not a beautiful pattern trading right here. We have like 2 touches on the top and 3 on the bottom. Arguably 3 on the top at this point in time. So if we break out from here, obviously we'll run into resistance at the 382. This is a new low right here. So this one is definitely less bullish than most. But at this point in time, we have a high, then a low. So realistically, anywhere we put in a lower high would still be acceptable for a bearish trend to the downside, but a bullish potential break. So what I would be looking at is the measure move breakout, which is, again, I'm just using the meat of the pattern, not being like too aggressive with this. But the measure move breakout is basically going to take us between the 200 exponential, the 200 simple, and the 236. So I would say somewhere around there would be our target for a potential bullish setup. Now, I don't know we're going to see that play out, and I don't know that this is the best altcoin to trade. But it amounts to, essentially, after the bounce that's already taken place, about a 60% payoff. So it could have a pretty aggressive move to the upside. So if we were looking at this for a favorable setup, and obviously we're a little, depending how you want to do it, you're either trying to buy support down here or you're trying to buy the breakout, probably retest right here. So essentially, you can run a pretty tight stop on this. I wouldn't want it maybe like a like less than 10% stop loss on this. You know, I wouldn't want to run it all the way back down to the 0.5. If we put in a new low, I don't want to be in the trade. It would be more like if we break out right here, come back down and retest, we take our entry. If it doesn't hold, we can get out right away, get stopped out or close our position. If it does hold and consolidates, we would expect that continuation to the upside. And that could give us, this roughly a 9% stop loss. So that would give us a 63% target to the upside. Now, obviously, we would probably take some off the table at like the 32% mark because that would basically be the previous high retest. And then the real macro target is somewhere up here around the 236 or something like that. So the initial target, 32% upside, 9% stop, 3.5 to 1. That gives us our stop loss at like just below 65 cents. Gives us our target at around 95 cents and our entry essentially right where we're at right now, assuming we break out and consolidate. And then the target 2 would be $1.19 to the upside with a same stop loss below 65 cents, same entry, and then that gives us a 67% upside with a 9% stop loss, which is like a 7.2 to 1, so a 7x your risk reward. So you bet $1. If you're right, you win 7. If you're wrong, you lose 1. Or you bet $1. If you're right, you win 3. And you're wrong, you lose 1. And then, you know, alternatively, obviously, you just keep part of the position open and run for that second target. Or just move your stop up to break even, depending if you're trying to log some profits or, you know, just get a risk-free trade. Either one is obviously favorable. But that looks pretty likely. I don't think it's ready to break down from this point in time because it just tagged the 0.5. If it did break down from here and go lower, obviously our target to the downside would be the 618. So on the macro, we're looking for something, you know, lower down here as our next potential area of support. But on the micro, I would say we're basically just looking for, you know, a slight breakout and then consolidation. And then, you know, that's when we're looking for the continuation and the actual trade setup to play out. So, but the 618 target would be like 36 cents. So that is what I'm seeing for the cryptos. Remember, if you are just tuning in, this is not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. Let's take a look at our commodities next. So we see gold finally got that breakdown, came all the way down to 200 exponential perfectly. It's now had 3 candles back to the upside on the daily and basically right back where the breakdown level was. So it broke down, found support at a key level, and now we're going to see if we can push to the upside. In my opinion, I would expect this to just put in another lower high, but we did come down perfectly and tagged our entry blue box area. So the target to downside has been hit. So now we're paying attention to, you know, our target back to the upside, which again is that same level, but also the potential target of the descending channel. So this channel is not perfect, obviously. I drew it quite a bit in advance without having an appropriate number of touch points, but arguably we could be getting something like, I need the other one. Could be getting something slightly angled, a little more like that, and that wouldn't be surprising. So now we have like those 2 wicks at the bottom. So again, we're waiting for this to develop a little more, and we'll have a little bit more accurate of a picture. But I do fully expect this to develop a descending channel that turns into the handle of our cup and handle, which forms the handle of an even bigger cup and handle. So I think target on gold back to like 1983, another like $90 to the upside. Doesn't have to go there though. It does look pretty weak. Has looked weak lately. But this could be, you know, we don't want to get too bearish right here on gold because this is the move we wanted. Because this is basically a breakout above the 200 exponential and simple, and then a confirmation retest. So if this holds as support right here, this is probably the beginning of a very strong uptrend. If it doesn't hold this support, it's just another fake out or another failed breakout or something along the way, you know, just some noise. But if this level holds right here, that could be the macro lows, and then we could go much, much higher on gold from here. So we really don't want to be bearish at gold after it hit our target to the downside. This is the area where we're really looking for gold to potentially take off from, or even slightly lower, but around this area. So silver came all the way back down, touched the bottom of the channel, as expected. Still looks like trash, much worse than gold, below the 200 exponential and simple. Had a nice little rally back up to try to save support. But silver looks like trash. It looks absolutely horrendous. If you were literally like hey, how's silver look? I'd be like shit. And if you were like, hey, how's gold look? I'd be like it's about to go on a massive parabolic move to the upside, maybe. So I think the difference between what we're seeing in these charts is enough to tell you that you don't want to be in silver right now. You want to be in gold. And then if we switch over to the weekly chart for the gold silver ratio, we've been discussing this for a while. And essentially, you guys all know what I said played out perfectly. So we consolidated at the 200 exponential for a while. We finally got the breakout to the 200 simple. And now we finally broken above the 200 simple. And now we got a little sell off to retest it as support. But now we see on the weekly, the 200 exponential and simple are both blue. So that's the beginning of a trend. So if we're having the beginning of a weekly bull trend to the upside, and we know the last few times this happened, it lasts for literally years and years and years, and ended with a parabolic like spike blow off top. I mean, silver could be potentially about to get crushed. Now, I don't know what the catalyst is for this. Maybe all of a sudden, China and Russia come out and say, hey, we are doing a gold-backed currency, and everybody who wants to be part of this new system has to have gold to back their currency with. I don't know. I don't know what's going to happen. I don't know what the catalyst is going to be. Maybe they'll be like, oh, it turns out half the gold on planet Earth is fake. So if you have the real gold, it's now worth way more because we made a mistake and a lot of this isn't real. I don't know. I don't know what the catalyst is going to be. I don't know what the news is going to say. What I do know is that the way this chart is telling us right now, that gold potentially has some serious upside in relation to silver. Now, my target was just an internal 50% retracement and then go lower. Does that have to happen? No. We don't know what's going to happen. And don't pay attention to the time of the target, just the actual levels of the target. Obviously, the time is just kind of there. It's not really what we're looking for. If we just put like a regression trend on this move to the upside, though, we can see we basically have a tight little channel playing out for right now. It's not super specific. We could probably get something maybe a little cleaner with a regular channel, or a little different at least. But as far as I'm concerned right now, we're basically just trading inside of this range, completing this B move to the upside. And then once this B move to the upside is complete, then we can really pay attention to, what's going to happen after that. We start running into resistance up here and it starts really looking like a top. Do we just continue to kind of chop along, this B, and then eventually we get to this level at like 92 or something, and then we go lower? What happens once we do get to that level? How much lower do we go? There's lots of things that could play out, obviously. But when I do draw these things, it's important, unless I specifically say I'm looking at timing or time cycles or something like that, it's important to just pay attention to the price action and not when it looks like something's going to play out. I always talk specifically about time if that's what I'm looking at. So XPD is next. Palladium, still neutral. It's between the 200 exponential and simple. They both technically have negative slope right now. It doesn't look great. Doesn't look terrible. XPT had a nice little rally back up here to retest the 200 exponential and simple. It is still below the 200 exponential and simple. We've talked about this potential setup quite a few times, about this area holding and a potential pushback up to the bottom of the range. Obviously, it hasn't held, and this has been looking like total trash. Could you take the trade setup right here? Sure. I think there's a million other things that I would rather be trading than like the worst metal in the best market. So in my opinion, platinum is just not worth touching right now. And I might have just said the names wrong right there, but the first one was palladium, the second one was platinum. ACB, Aurora, trying to do a double bottom action right here. Obviously finding some support, kind of carving out a bottom at that 0. So could we look for a potential entry back up here? We could. Are we just getting greedy if we look at something like that? Or is there actual reason for a further trade setup? Could go either way, honestly. I mean, we really want to see some kind of nice favorable trade setup coupled with the divergence. So if we look at where we're at right now and we say, okay, if we go to a new low and close lower, we don't want to be involved in this trade. So our lowest close is obviously at the 0, but we poke down slightly below it for this wick right here. So we technically have a lower low, but not a lower close. So it's kind of whatever at this point. But that being said, when we look at the actual chart, here we have a low, here we have a much lower low, and then here we have a low, here we have a much higher low. And then when we look at the actual close, here we have a low, and here we have the same low. So regardless of how you look at it, both of these are printing, some form of bullish divergence, essentially, because the price action is diverging from the indicator oscillator. One took more energy to get to the same level, one took less energy to get to the same level, and they're diverging from each other as well as from price action, one in either direction. So what does that mean? Well, it means anything could happen at this point in time. We have no confluence between these indicator oscillators. Now, if we wanted to take a stab at this being a double bottom, do I think this is a favorable entry point? I mean, there's a nice setup because we have a stop loss of 9% if we take out the low close on the daily, and we have a target to the upside of that neckline or the 236 of 37%. Now, the real question is, have you been trading the pot stocks, and are you making money trading the pot stocks? Have you been hodling the pot stocks, or have you just been building a position on pot stocks? Because those can make a huge difference. Because right now, this could be, if this is the bottom, it's a double bottom with divergence potential. If this is the bottom, this could turn from a great scalp or swing trade into, one of the best positional trades of the next 5 years. Or it could just go lower. So we want to be ready to get in and out of these trades again and again and again, and either leave some of the profits as a potential like building a position, or just be ready to re-enter if we see continuation to the upside, but taking profits along the way. At least that's how I'm playing these pot stocks. Because I'm still not convinced they don't go lower, but at this point in time, they're so wrecked. Anytime they put in a new low or have another like big sell-off to a key level, the moves back to the upside are so big. I mean, this is a 37% move. The move from 319 to 437. And we're talking about a stock that, topped out in 2018 at $144. And this is a real company. $144 stock. I'm not that worried about the difference between 290 and 320. And the moves to the upside for just $1 or $2 or $3 can turn into massive moves, percentage gains. And then assuming we do finally get like some sort of double bottom, breakout, retest to the 382 or something, I mean, we're talking about over, close to 100% move to the upside. So I'm looking at this. There's definitely some favorable setups right here on some of these pot stocks, but we have to be fully prepared to either close our position, get stopped out, or take profits regardless of what ends up happening, because in no way, shape, or form am I trying to call the macro bottom on these things. But there's definitely some meat on the bone for a potential trade. So we're looking at Tilray, and obviously we already took this trade setup and it played out nicely. But now we see we came back down here again, and you obviously know the mentality of why we initially would have placed our stop losses at this level. Because it was if we closed a daily below the previous low and showed more weakness. So even looking at these old trade setups, which obviously are no longer in play, we're looking at potential and saying, okay, that area actually held again. So if that would have, let's say this burst to the upside never happened, and we just kind of like rolled over right here and came down, we would technically still be in this trade setup if we didn't already take profits. So that being said, there's potential to basically just take the same trade all over again, because we got the same low basically right here, and then we have a high right here, a higher high right here, and then potential for the higher high here. So now we could potentially have the second trade setup play out, and be something close to like another 50 to 80% move to the upside on Tilray. So 836 would still be resistance, but at least it would tag the 200 exponential and simple after diverging away from it since, we haven't tagged it since November of 2021. So we got close right here. We sold off pretty heavy. Not unrealistic to think we come back up to that same level one more time and turn into basically just like a range or like channel trade right here. But I'm seeing some serious potential for another like 50% move on some of these pot stocks off of the lows, assuming that they bottom. Now, again, if we look at this right here, we see where the close is, and the close is slightly higher here and slightly lower here. And then again, if we look at our indicator oscillators, we have a low right here and a lower low here. And then we have a low right here and a lower low here. So we have a lower low on both indicator oscillators right here, but we have a higher low, or arguably the same low, on the price action. So again, we're seeing bullish divergence off a potential double bottom right here. This time we're seeing confluence between our indicator oscillators. So this trade looks pretty favorable for a potential setup. Now again, could easily just fall on its face right away and go straight to zero, and we'd actually be running a tighter stop loss now, just because we would take an entry off of, you know, where we're at now versus getting slightly higher. Now you could wait for it to go slightly higher above the 8 and 21, take the same entry as last time, and then just ride the exact same trade setup. Could go either way, but there's definitely something there. So then uranium stocks, CCJ. So it came back to our ascending support line perfectly. Tags it a couple times. Didn't quite get to 200 exponential and simple. I suspect it will. Looks fairly weak. We're about to get earnings on this on the 5th. So we're going to pay attention to that, obviously. URA is next. So a little weaker. Got below the 200 exponential and simple. We have some key levels slightly below it. Holding for now. We do have a lower high on this one, so this is much less bullish in comparison to some of the other charts we're looking at. UEC, so it did put in a higher high right here. It gave us our macro 0.5 and then came down basically to the 200 exponential and simple. Again, I look at these as buying opportunities. I want to see them come down slightly lower, but I just don't know if we're going to get those lower targets. We'll see really what happens. I mean, it's tough not to just get excited about energy, but it's already come so far along the way. So there's a lot more risk after it's moved as much as it has already. So we're looking at something like an ascending wedge, you know, with a couple touch points on the top, couple on the bottom, nothing too clear. Getting pretty ugly of a chart right here. We'll see what happens. Basically, like, as long as we're below the 821, it doesn't look great. As long as we're above the 200 exponential and simple, it looks good. And then UROY looks much worse. It did break down below the 200 exponential and simple. It did lose that ascending yellow support line. So probably, maybe this is a canary in the coal mine and it's telling us we're going to get that move to the 382. Hopefully it corresponds with all the other charts. But maybe we'll just end up loading up on this one. You would think, honestly, that the royalty company would be doing better than the actual uranium stocks because of the cost pressures on, like, the actual commodities. You know, there's a bunch of extra cost with, you know, energy, labor, etc. So it digs into your profits. As where a royalty company doesn't have anything to do with the costs, just has to do, you know, with the uranium coming out of the mine, basically, or, you know, whatever your royalty is for. But in this case, you would think that the royalty would be outperforming the underlying, but that is just not the case. So we're seeing some divergence between the royalty and the underlying, telling us that either the market is really smart and the cost inputs are going to come down, aka labor and energy, and this is priced into the royalty market and not into the regular market, or that the royalty is underpriced right now, costs are not going to come down, and this thing is going to have a massive rally in relation to uranium because this is underpriced. That's what it looks like to me. So we don't know which one of those scenarios is going to happen. I can make a strong case for either one of those scenarios possibly happening, but that seems like that's what the market's telling us, in my opinion, at least. So if you're over there in the comments section, make sure to chime in tonight. Let me know how you guys are doing. You know, obviously the tube loves it when I get the interactions. So, you know, if you've got some bots on standby, now's the time. Unleash the robots. You can spam us with your whatever made up crypto scam coin you have or something like that. Or, you know, bots, if you're out there listening, but you're blocked, message me. I can unblock you for some interactions. But that being said, let's go ahead and jump right into our traditional markets and see how they reacted today. Obviously, remember, for everyone here and just now tuning in, this is not financial advice. It's not financial advisory. Your markets are extremely volatile. Please do your own research and trade responsibly. So TNX hanging out at the top of the range, looking pretty toppy. We see some short-term divergence. We're looking for a pullback on this. Just a retest breakout levels, maybe like 2.6. Do we get it? I don't know. I really don't. It's tough to tell if this was just a reaction rally because the Fed was not more bearish or not more hawkish than they were, or if this is going to be sticky. I wouldn't get too excited about it for now, and I'm not getting too excited on the crypto plays for now either, because I do fully expect all these setups to just roll right back over and just immediately go to zero. So definitely don't do anything I'm demonstrating. It's for, science purposes only. So TLT, we saw a slight little bounce, hanging out at the bottom of the range, hanging out at the target. I mean, this was our downside target. We actually touched it 2 days ago. So we finally hit the bottom support line. We've had this support line in play for literally months and months and months. And it goes back a ridiculously long time, as long as this chart existed for, which is only 15 years or something, but still. So we have this random trend line that we've been respecting forever with an exact target to the downside, and we hit our target. So I don't want to get overly aggressive saying it's going to go much, much lower now after we literally just hit our target, ascending support perfectly and our green box perfectly. So in my opinion, there could be a legitimate scalp in the bond market getting ready to go into play. Probably not going to be good for equities, though, because that money's probably flowing back out of equities and then back into the bond market. So still not getting a great favorable setup for some all of a sudden bull run. But bonds have some potential. U.S. oil retesting that key Fibonacci level at resistance now. Could go either way. I'm still not going to get bearish on energy, but we do look kind of toppy here. Dow Jones Industrial, so obviously had a massive rally off of today's Fed meeting. So, again, what is that? I mean, technically it's a higher low, so that's good. Technically it's just a retest, trying to get up back to the 200 exponential and simple. That's good. Chart is still bearish. So it's trying to make a move right now. We'll have to see if any of this is going to be sticky or not. SPY, same thing. We did not put in a new low based on closes. We did technically based on a wick, but not based on closes. Well, I mean, technically this is an open, but you know what I mean. There's a gap down open. So we'll call that an unofficial close. But technically we didn't put in a new low. Again, aggressive move back to the upside. Hard buy signal. Green histogram. Looks like it's coming up here to retest 200 exponential and simple. Every time it's failed, we're still in a bear market. I don't expect all of a sudden the markets to change around because Powell only did 50 basis points. Because remember, not that long ago, everybody was saying they're not going to do 50. They're only going to do 25. And then now they do 50 and everybody's like, oh, well, they said they might do 75 and they only did 50. So there's always going to be some made up bullish case for everything. So IXIC came down here, put in a new low, almost completed the measure move. Not quite on the NASDAQ. Coming back up to retest the resistance. So could it push all the way back up to 14,141? It could. Again, I don't want to get overly bullish on this. Until it goes above 13,1, it doesn't look good to me. I mean, it still wouldn't look good to me, but it looked better at least. The Russell, again, looks terrible. Broke down from the channel. Hit the measure move of the channel probably perfectly. Maybe slightly underperformed. I don't know. We'll see. So slight underperformance of the measure move breakdown. We would expect it to go slightly lower. But now we pay attention to the 236 retest and the bottom support retest. If this gets rejected here and rolls over, we're probably headed down to complete that flagpole. A lot of these things are quote unquote oversold. So they were looking for a reason to rally. So next we have XLE. So we talked about this XLE situation. And again, not to be a stickler, but, we talked about how this was basically a pretty aggressive bullish buying candle right here. And also how I really wanted to see this come up and hit my target. And again, I'm not trying to always be oh, it's not finished until it hits my exact target to the T. I don't want to be like that. I want it to be the market has to hit my exact target. But that's typically how the market reacts. So if the market has the same target as me, it's going to want to try to come back up here and hit that target for the same reasons I always say, I wanted it to go a little bit higher and stop at a technical area. So here's our 2.618 at 83.20. We just put in a new high with a close and a wick. So we're so close now to hitting the target. I think we're going to get up there, hit that target, and then we can really see, is this thing getting tired? Is it going to be done, or is it going to go higher? But we see here now 1, 2, 3 drives of bearish divergence already confirmed, and we're getting ready for a potential fourth one because we already have a higher close and we're much lower on the indicator oscillator. So is this going to be the big fourth drive of bearish divergence that tops out exactly at my target and then rolls over and we get an aggressive sell-off? Maybe, probably, but who knows? So XTN, transportation, trying to do something. We got some serious resistance, the top of our yellow support and then the 200 exponential and simple at 88. So again, we put in a new low, then we put in a higher low. So this is going to start looking okay, better than some things, but overall not bullish on transportation. XLF Financial put in new lows, pretty aggressive rejection of lower prices, and then obviously everything saw a bounce today. Today was just an everything rally, because the market was like, oh, we priced in 50, so if we get 50, it's bullish. As long as we don't get 75, no matter what happens, it's bullish. That's how the market looks at today's meeting, in my opinion. That's what I was discussing with the group. That as long as we basically don't get like a super hawkish Fed or like some unpredictable moves or crazy volatility from JP's mouth, which he's a robot, so I wouldn't expect that to happen, or a puppet, however you want to look at it. But realistically, I mean, this was the move we were expecting. So, we have obviously some various levels we've been paying attention to, whether you draw the channel like that, whether you look at the wicks. I mean, we're seeing some clear, bounces off of either the closes or the like descending line right here with each of those wicks. So still just range bound. Technically bearish below 200 exponential and simple. Financial looks weak. All of this looks weak and just looks like a random reaction rally. I mean, it's a nice aggressive candle after things try to carve out a bottom, but we need to see some kind of follow through in these markets. They've been pathetic lately. XLV, healthcare, retesting 200 exponential and simple, not putting in a new low. Again, we see all these things down in the bearish control zone, trying to roll back over. So, I mean, the real question is how much do these rallies have legs or not? XLU bouncing key support. So we finally made it down to our yellow support, found support, and now we're bouncing back up. Starting to lose some strength, but it looks like it's going to try to push up slightly higher. XLP, consumer staples. So we lost that key support we were paying attention to, came back down to our yellow support here, and then we bounced all the way back up to the red ascending support, acted as resistance. That's exactly where we stopped. So now we have to see what happens after this. This chart actually does look weak. I am overall bullish on this compared to most things, but it looks like it wants to get rejected and rolled over right here. XLRE, real estate, retest of the 200 exponential and simple after it failed to hold. We did not put in a new low, so again, that is slightly bullish, but we did lose the 200 exponential and simple. 200 exponential has flipped over bearish. 200 simple is basically flat now. So if we don't get back above 47.47, this is going to confirm a bear market for the first time this cycle. That is real estate. VWO, emerging market ETF, retesting the breakdown resistance, did not put in a new low. Again, very, very close. Retesting that resistance, trying to pick up momentum. All these charts look very, very close to the same. Everything basically just had a reaction rally, except for Germany. Germany does not look good. It did nothing. Everything else had a pretty aggressive rally. Germany did not. They're in a tough spot right now because, in my opinion, Germany is really getting the short end of the stick on all this, because they basically got stuck between the entire West and Russia on the Nord Stream 2 deal. And now they're basically getting kind of the shaft on this, liquid natural gas situation as well. They're obviously extremely reliant on Russia. And then also they're seeing a lot of pressure from, Europe and United States. At some point in time, they have to decide whose interests do they have in mind. Do they have Germany's interest in mind, or do they have everybody else's interest in mind? Because Germany is going to pay the price. And I see a clear parallel with what's going on right now in Germany and what's going on in Ukraine. And again, I'm not defending Russia. I'm not defending Ukraine. I think it's horrible when countries are at war, especially over stupid stuff, especially super corrupt countries fighting proxy wars. But the truth is, what's really happening in Ukraine is the West is basically at war with Russia right now. But they're not technically at war because they're using all their stuff, they're using all their equipment, and they're spending money as if they're in a war, but they're using other people's bodies, other people's lives. So essentially, Ukraine has been tricked into being the pawns of the West to fight Russia, to weaken them. And that's why all the allies are giving them all this equipment and all this money, is because they're basically like, yeah, go do that. Because here's the thing. If the West in general, or whatever, any specific country, NATO, etc., goes to war with Russia, people start dying, people get pissed. Like, people from those countries don't like to see their citizens dying in some war that they're not even sure if they care about. You know, for a country that they're not even sure if they care about, that they couldn't even point to on a map a couple months ago. So you can easily send money, you can easily send military equipment, and we can work that out. But when you start sending home boxes with dead sons and daughters in them, that's when things look bad. So right now, in my opinion, Ukraine is being like the dirty pawn of the West. They're basically just sacrificing their land and their soldiers and their lives and, you know, their future to fight a war for the United States and the rest of the West. And what is the goal of this war is really just to, you know, deplete Russia of some of its resources, military, or to just kind of overextend them. So it's basically just a proxy war. You know, we're like, yeah, we'll pay for it. Like, hey, I'll give you some boxing lessons and you can go learn how to fight as long as you promise to go fight the bully, because I don't want to get punched in the face. But I don't like that bully either. That's what's going on. We're basically just, you know, helping Ukraine fight the bully by funding them with money and, you know, war stuff. It's a crazy situation. Crazy situation. So, you know, right now, in my opinion, you know, the Russian people, in no particular order, the German people, and the Ukrainian people are all pretty much getting screwed by everybody right now. Love it or hate it. And that's probably why Germany does not look good. It's because they're kind of stuck in between a rock and a hard place right now. So CN50 China still trying to close above the 821, slowly tightening, starting to look okay. Probably does get that retest of 14,616. China still looks terrible though, and they're going into like massive, crazy new lockdowns, and I have no real interest in being invested, quote unquote, in China. Maybe some scalp plays, but UK 100, the FTSE 100 index, again, very strong. Found support 200 exponential and simple, back above the support line. You know, headed back up to retest the highs, maybe 76.85. Seems likely at this point. EWZ, Brazil. So we came down, dug a little deeper, got to push back up, retesting the 200 exponential and simple. I'm still looking for a target down here at like 29. You know, call it 30 for an entry. Maybe we don't get it though. It looks like this is trying to go up here. We'll see. It's starting to roll back over, looking moderately bullish. All right, let's look at a couple more of our big stockeroonies and the DXY. So DXY had a pretty aggressive sell-off. Obviously corresponds with a rally in gold. We did get the divergence signal we were talking about, the sell by sell. So here's the thing about these. If they're spaced out like this, they're slightly less reliable. If they're spaced out where you have two next to each other, a space, and then the other one, that's pretty reliable. If they're all three right next to each other, or there's just one space between each one, or the spacing between each one is pretty accurate, like the same. If it's, say, one in between each or two in between each, it's still pretty reliable. But when it's like this, it's a little less reliable. So we have to watch out, sell by sell. We have some divergence showing up on the chart. We're obviously getting a pretty aggressive sell signal. So I do expect this to come back down and cool off. I would like to see a retest of 100 and then see that hold. And that would give me confidence that the dollar's going higher. But the monthly chart is already super juicy. So no reason to get bearish on the dollar. Tesla chart, we came back down to our little like descending support / resistance. Found support at that level, at our horizontal, at the 200 exponential and simple. Elon says he's done selling. Hard buy signal. So where do we go? Back to the top of the range? Probably just go right back up here to like 11.27. I mean, we hit our 900 target. So I'm going to let this develop a little bit before I get too particular. I mean, when we hit our targets, I don't need an immediate next target right away. Not everything has to reverse exactly where we want it to. It usually does, but it doesn't have to. So NVIDIA next. So we're literally pennies off of our buy area down here. It did put in a new low. It did find some support. Again, hard buy signal coming out of the bearish control zone. We can see all these charts were just so beaten down. Some put in new lows, some didn't. Some put in bullish divergence, some didn't. Some are, more bullish or more bearish than others. Looks like Nvidia probably comes back up, closes the gap around 232 now. None of these charts look strong technically though. So Apple bounced the 200 exponential and simple, did not put in a new low. So again, you know what we're expecting. We expect every time we come to 200 exponential and simple that we bounce it until we don't, until we start closing below it, and then we'll expect it to act as resistance. So Apple is one of the few charts still looking bullish. Microsoft obviously broke down below it, consolidated below it. So now potential bullish pushback up to 200 simple like 305 looks likely. It is already using quite a bit of juice here to go nowhere. So we'll see. Microsoft definitely not looking nearly as good as Apple anymore. They were both looking really good for a long time. Not so much anymore. So Amazon obviously broke down, hit the measure move, put in new lows, back retesting our Fibonacci as resistance now. Obviously that was our target. We overshot it slightly. So do we come back up here and close the gap? Maybe 2760, maybe. We'll see what reaction the market gives. But obviously we overshot the 382 a little bit, and we are trying to reclaim it right now. Netflix, same situation. We had a massive gap down, trying to get that cross back to the upside. It's going to have some real trouble getting back above 238. If it gets back above 238, it probably closes the gap and goes to 330. So we're talking about like a $90 move, or like 30%. And if we go from 200 to 330, that's a pretty nice move too. But what is the catalyst going to be that all of a sudden everybody becomes buyers? Because I don't know what it is. And when we look back at this chart, we're talking about 2017. Anybody that bought Netflix since 2017 is upside down in their position right now. So there's just so much overhead resistance. I just don't know if we can get anywhere. I mean, we could probably get back to 237, but I don't know if we go higher than that. I mean, just I do this a lot, obviously, but it really helps to, illustrate what's going on here. I mean, this is all potential sellers. Anybody that bought for this, almost 5-year period, well, 4 and some change year period, is upside down. And some people are upside down from the high at 700. So, and now we're at 200. So some people are massively down on these positions. If you're lucky and you bought 4 years ago, you're at least just even. But that's 70% down from the highs. And you're like, well, it's already down 70%. So how much lower can it go? I mean, a lot lower. A lot lower. I mean, from where we're at now, going down to the 382 is another 38%. So if you bought in right now and just said, F it, I'll hold, and then it goes to the 382, it's another 38%. If you bought at the high and just held it down the rest of the way, that's 83% downside. So what amounts to the difference between from the high to here is 70%, from the high to here is 83%. What amounts to that 13% difference between the 70 and 83, really, if you're a buyer at this level, amounts to another 38% downside for that capital in the meantime. So we got to be real careful with Netflix. I mean, this thing does not have to rebound anytime soon or ever. Google broke down to a new low, slightly overshot our target. Again, don't want to get bearish down here at these key levels, but reclaim the 236, pushing back up, trying to retest the breakdown level. We got 200 exponential and simple all the way at 2674. I mean, it looks like it's trying to head back up there. It's going to have a tough time getting through 2500, so we'll see. Again, I'm talking about short-term potential bounces to the upside, but nothing has changed on my macro view. I'm still very bearish on all these things, especially if they're below their 200 exponential and simple and the slope is to the downside. So Facebook, Metro. So 223 right now. It did put in a new low. It did hold that massive ascending broadening wedge support. Now, technically, it didn't hold it. It had a breakdown from it, but it reclaimed it. Also at the 618, almost hit our 786 target. So does Facebook get that big pushback up? Again, maybe it gets to 250 and then it has a massive gap there. It's going to have trouble getting above there, though. And again, we're talking about, what, 2018 July levels? So this isn't nearly as bad as Netflix, but there are a lot of sellers up here. I mean, there's a lot of price action above our head that we would expect to act as resistance. And we basically made it back to, that was our pre-Pandorama levels before the big Rona dump right there. So we came all the way back, gave back part of that, and now we've at least reclaimed it. So if we just deleted the last 2 years and some change off the map, and it's still like January 2020, everything's fine. We don't know about what's about to happen to the world and all the craziness. And it's like, hey, I own Facebook and everything's gravy at 220. I wonder what's going to happen over the next couple of years. I mean, we get a drawdown all the way to 136. We pump all the way up to 383, and now we're all the way back at 200. I mean, your guess is as good as mine on this. I see some pretty massive bullish divergence between this drop and this drop, this drop and this drop. So we obviously have a much lower low here and a much lower low here. So some bullish divergence, definitely. I think if we take out the neckline right here, how would I look at this? I guess as a W, kind of. Not really like a head and shoulders. I guess realistically what I would be looking for is from the, again, we're going to take the more conservative move from the shallower V up to what would amount to the neckline. And then a break would take us above that neckline. So we want to look at the horizontal, like right here, basically. So if we get up slightly higher and we break above 234, we probably get the measure move, which again is just basically from the neckline to the bottom of the V. And then that basically takes us all the way back up to fill the gap, which was that 300 target. So maybe that's what's going to happen here. Maybe we finally get that push up and fill the gap on Metro Facebook. What percentage gain? I mean, assuming we bought the breakout on a retest or just entered now, I'm talking about like 25% move, but we're quite a bit off the lows too. So I'm not sure you're going to find a very favorable risk reward, because when would you want to get stopped out? Well, here, if you're going for the lows, so it's 1-to-1. So the real argument is if it breaks out right here and consolidates, and then you just put in a tight stop, or you take a breakout, from where we're at right now with the tight stop, and say if we go down below 209, you want to be out of the trade, but your target is going to be 300. There's some argument there for some kind of trade setup to play out. I think that could probably work. I mean, if you basically said if we close lower, I want to be out of this trade than that previous daily candle. But the real target is the gap fill. So we're talking about 6% stop loss if we keep the tight stop. Without the breakout trade, and a 32% target to the upside. So we're looking for basically 300 on the upside target, 295. We're looking for a stop at 209 and then an entry at 223 where we're at right now for a 5.5 to 1 risk reward ratio. So there's some potential bullish plays to be had. Now, it is worth noting too, as we wrap up today's video, that because all these stocks or most of these stocks or cryptos or assets are in bearish trends, that our probability of success is below 50%. So if we're going to take a scalp to the upside on a bearish chart, our probability of success at best, let's say, is 40%. So 60% of the time, the trade is going to fail. So 3 out of every 5 times we take this trade, it's going to fail. So when we figure out our risk reward ratio, if 3 times it succeeds and 5 times it fails, and we're taking 2-to-1 risk reward ratios, we would make basically, we would take the 3 times failing, and then we would multiply it by the 1, because 1 lot would be our stop loss. So that's a 3. And then we would take our probability of success, which is 2 times succeeding, and then we take our risk reward ratio, which is 2-to-1. So we multiply those. So the 2 times 2 becomes 4. So now we have a 4/3. So a 4/3 is still over 1. So if we take the trade a bunch of times, we're still going to make money theoretically in the long run, but our gains are substantially less. So it's much less of a favorable setup. As where, let's say, for instance, we have a 2-to-1 trade setup in a bullish market. So if we have a 60-40 in our favor, and we have a 2-to-1 trade set up, we're going to take the 60, which is 3 lots, and then we're going to multiply that by the 2, so we're going to have 6. And then we're going to take the 20% failure rate, or 40% failure rate, which is, 2 20% lots. And then we're going to take that and multiply that by the 1, the denominator. And now we have 6 over 2, which is 3 to 2. So taking a 2-to-1 trade setup in a bullish market with a 60-40 probability of success gives us a substantially higher gain, because we were talking about 4 over 3 versus 6 over 2. So if we look at that and we say, wow, that extra 10% bullish or bearish makes a massive difference, even if we're still taking a 2-to-1 risk-reward ratio. Because obviously, depending on if you reduce it or not, but 6 over 2 compared to 4 over 3, one is substantially better than the other is. So that little bit of a difference is why we trade with the trend, because that 10% in either direction really amounts to about 50% more success or failure. Because if we basically say a 50-50 failure is 1-to-1, 50% success, 50% failure, that's 1-to-1. That's even odds. You're going to be right if it goes up or right if it goes wrong, but nothing else taken into account. As where if we take that extra 10% in either direction, making it 60-40 one way or 40-60 the other way, or 60-40 the other way, however you're thinking about it, that extra 10% in either direction turns into a substantially bigger difference on our payout if we're trading with the trend. Because essentially what it amounts to is the 40% lot, if we're trading against, is like 2/3 versus 60% success if we're trading with, which is 3 over 2. So we're talking about realistically a 50% more chance of success, which is crazy as that sounds. 2 to 3 versus 3 to 2 is a substantially bigger difference. So when it's all said and done, trading with the trend and then paying attention to not only position sizing, but the risk-reward ratio is crucial. So if we're trading with the trend and we're using favorable risk-reward ratio, we're going to always do the best. If we're trading against the trend and we're using favorable risk-reward ratio, we can still profit with something as low as a 2-to-1 risk-reward ratio, but we really want closer to like a 3 or higher. Because again, if we take that same setup and we look at it as 2 and 3, or 4 and 6, 40% versus 60%, depending on how we're looking at it. If we take that same 2-to-1 risk-reward ratio and we say now we're going to take a counter trend trade with a 3-to-1 risk-reward ratio, so we still have less than 50% probability of success, but now we make $3 if we're right, 1 if we're wrong, then we can multiply those out and we end up in a much more favorable position. Because if we take the 3 and multiply it by the 2, that's going to give us 6. And then if we take the 1 and then multiply that by the 3, that's 3. So the 3-to-1 ratio at 40% probability of success translates to our 2-to-1 minimum risk-reward trade setup that we always want to have. Because now you're factoring in not only the percentage move or gains or losses, but you're also factoring in the probability of success. So if we're trading against the market, the minimum we want is a 3-to-1 risk-reward ratio with a 40% probability of success. If we're trading with the market, we still want a minimum of 2-to-1 risk-reward ratio, but we get a higher payout. And then if we're trading in a neutral market, 2-to-1 risk-reward ratio is the minimum we want. And then obviously that's not going to mess with the ratio at all. So a little breakdown there. I think sometimes people don't take into account, I should do like a chart or some kind of visual tool instead of just talking, because I think it really hits home closer if you see the numbers right next to each other and you say, oh, wow, that's crazy. The difference between trading with the trend, is the difference between a much more favorable outcome in comparison to trading against the trend. Even when we have a good risk-reward ratio, it's still not worth trading against the trend. But if we have a great risk-reward ratio, there's a strong case to be made for those counter-trend scalps. So, but I think that's where we're going to wrap it up today. I think I got all the requests in there. If I miss one, let me know. CW says, I am fully investing into Netflix so I can get my Cuties 2.0 the legal years when it comes out. Dude, that is so messed up. I don't know anything about cuties except for what I heard about it, but that's how you know it's like end of days. Yeah, everybody smash up those like buttons. I definitely appreciate y'all. Appreciate everybody showing up today. I know it's been a little quiet. I'm getting back in my groove myself. I know everybody else is too. But going into the second quarter here, one negative GDP print, one Fed 50-point basis point rate hike behind us. This is going to be an exciting couple months, and there's going to be some serious money made in the next couple months. I mean, if we even get one of these potential trade setups to play out on like pot stocks or even some of these cryptos, we'll be sitting pretty for the next few months. Nice little 50% rip on one of these nice trade setups could, that's all we're really looking for is a couple big ones and then, a couple small ones in the meantime and just consistency. So going to go ahead and wrap it up there. Appreciate everybody tuning in. Thank you for your thank yous, CW. He said, thank you for your time. As always, excellent work. So we'll go ahead and wrap it up there. Remember, this is not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. It is Wednesday, 9:35 p.m. Eastern Standard Time on May 4th, 2022. May the 4th be with you. Everybody loves that 4th of May day. That being said, going to wrap it up there with our midweek market update. Make sure you tune in on Friday for our 11 a.m. to 1 p.m. Eastern Standard Time Friday market wrap up. And then we will have, of course, our Sunday and Wednesday stream going into next week. Every single Sunday and Wednesday, starting at 8 p.m. till roughly 9:30, 10 p.m. Eastern Standard Time. But that is it for today with our midweek market wrap up. I am Crypto Trend Trader, and I'm out of here. Peace.